selling a home, for most people, it's not just moving house, is it? It's often the biggest single financial transaction they'll ever handle.
Absolutely. It's a huge deal.
And then you get near the closing table, and suddenly this like complex maze of federal tax rules crashes right into these really unique state and local taxes.
Yeah.
And frankly, the sheer number of figures flying around can be just completely overwhelming.
Okay, let's unpack this. We've got some solid source material here detailing what really happens when you sell property. And we're zoning in specifically on Washington State.
Right.
Because the tax landscape there is, well, unique, and let's be honest, often pretty misunderstood. Our listener really needs a clear path through all this potential confusion.
That's exactly right. Our mission today in this deep dive is just pure clarity.
Good.
We are going to tackle those core tax burdens, federal versus state, and crucially address the single biggest point of, I think, recent anxiety for Washington sellers.
Which is understanding the two very different state taxes. We really need to nail down where the tax on the price hits you and where any tax on the gain, the profit, might hit. Or doesn't it?
Okay, so price versus gain at the state level. And critically, we're going to pin down whether Washington's much talked about new capital gains tax actually applies when you sell your house.
Yes. Spoiler alert on that one.
Yeah.
The answer is likely a massive relief for most people selling their homes. But we absolutely need to walk through why that's the case. It's explicit in the law.
Good. Let's do that.
Precisely. So we'll start by clearing that main hurdle first, the federal foundation. Because honestly, if you can maximize those federal exclusions, you've probably won like 90% of the tax battle right there.
Okay, federal first. Let's start with the basics, the math. Defining the federal capital gain. What is it?
It's essentially your profit, calculated in a specific way.
Right.
You take your final sale price, the number on the contract,
Okay.
and you subtract your adjusted cost basis.
Okay, adjusted cost basis. That sounds important. It's not just what I paid for it originally.
No, exactly. That's a key point. It starts with what you paid, yes.
Yeah.
But then you add the cost of any major capital improvements you made over the years.
Like what kind of improvement?
We're talking big stuff. A new roof, adding a room, a major kitchen or bathroom renovation, significant landscaping, a new HVAC system, things that add value or extend the life of the home.
Not just like painting a room.
Generally, no, that's more maintenance. Think structural or significant upgrades. And then, importantly, if the property was ever used as a rental, you also have to subtract any depreciation deductions you claimed during that rental period.
Right, depreciation. We'll need to circle back to that. So sale price minus original cost plus improvements depreciation. That's the gain.
That's your potential federal capital gain, yeah.
And this is where, the biggest break usually comes in, that federal exclusion for your primary residence.
Exactly. This is the big one for homeowners. If you qualify, you can exclude a very significant amount of that gain from federal income tax.
How much?
Up to $250,000 of gain if you're single.
Wow.
And even better, up to $500,000 of gain if you're married and filing joint tax return.
$500,000 potentially tax-free. That's huge.
Yeah.
But there are rules, right? You have to qualify.
Oh, absolutely. The IRS has very specific requirements. These are the gatekeepers.
Sure.
You need to satisfy two core tests, an ownership test and a use test.
Ownership and use. Tell me more.
For the ownership test, you must own the home for at least 2 years.
Okay.
During the 5-year period ending on the date of the sale.
2 of the last 5 years owned it.
Got it. And the use test is similar. You must have lived in the home as your primary residence.
Lived in it.
Yes, your main home, for at least 2 years during that same 5-year period.
2 years living there out of the last 5. Okay. Do they have to be the same 2 years?
They don't have to be continuous or the same 2 years. But you need 2 years of ownership and 2 years of residency within that 5-year window before the sale.
And I think there's a limit on how often you can use this.
That's the other key rule. You generally can't use this exclusion if you've already excluded gain from selling another home within the 2-year period before the current sale.
So one exclusion every 2 years, basically.
Pretty much.
Okay. So what if you don't qualify? Maybe you flipped the house quickly, held it less than 2 years, or it was always a rental property.
Right. If you don't meet those tests, or if it wasn't your primary residence, then that gain we calculated earlier becomes taxable at the federal level.
How is it taxed?
It depends how long you own the property. If you owned it for more than 1 year, it's a long-term capital gain.
Okay.
And those are taxed at preferential rates, currently 0%, 15%, or 20%, depending on your overall taxable income level. Much lower than regular income rates for most people.
But if you owned it for a year or less? Like a quick flip.
That's a short-term capital gain.
Right.
And that gets taxed at your ordinary income tax rate, the same rate as your salary or wages.
Ouch. So that could be significantly higher.
Definitely. Holding for more than a year makes a big difference federally.
Now, you mentioned something earlier. Is there sometimes an extra tax on top of those capital gains rates?
Ah, yes. Good catch. For higher earners, there's potentially another layer. It's called the net investment income tax, or NIIT.
NIIT.
It's an additional 3.8% tax that can apply to investment income, which includes capital gains from selling property if your modified adjusted gross income, or MEGI, exceeds certain thresholds.
What are those thresholds roughly?
Generally, it's over $200,000 for single filers and $250,000 for married couples filing jointly.
So if your income is above that level, you might pay the regular capital gains rate plus another 3.8% on that gain.
That's correct. It's an extra bite specifically aimed at investment earnings for higher income individuals.
Okay. Now, you mentioned depreciation before if it was a rental. You said we need to come back to it. Sounds like there's a catch there.
There is, and this is the critical detail that catches so many sellers completely by surprise, even sophisticated ones. It's called depreciation recapture.
Depreciation recapture. Sounds ominous.
It kind of is. So if the property was ever a rental or used for business like a home office where you claim depreciation.
Right. Those deductions you take each year against the rental income.
Exactly. Those deductions lower your taxable income each year you rent it out.
Yeah.
But the IRS basically views that as a kind of temporary benefit. When you sell,
They want it back.
in a sense, yes. The total amount of depreciation you claimed over the years is recaptured. It's pulled out from the rest of your gain and taxed separately.
How is that part taxed? Is it like regular capital gains?
No, and this is the kicker. It's taxed as ordinary income, but at a special maximum federal rate of 25%.
25%. Wait a minute. Let me get this straight. Say I meet the 2 out of 5 year rule. I lived there the last 2 years. My overall gain is, say, $600,000, so $500,000 is excluded because I'm married. But before I lived there as a rental for 5 years, and I claimed, let's say, $50,000 in depreciation during that time.
Right.
Are you saying that even though most of my profit is tax-free under the $500 exclusion, that $50,000 slice from depreciation still gets taxed?
That is exactly what I'm saying.
Wow, at up to 25%.
Correct. You cannot use the primary residence exclusion to wipe out the gain attributable to depreciation you previously claimed. The IRS claws that specific portion back.
So that $50,000 is taxed at ordinary rates,
Yeah.
capped at 25%, regardless of the main exclusion?
Precisely. It gets pulled out first. This makes keeping really good records absolutely vital if you ever rented out the property. You need to know exactly how much depreciation was claimed.
That's a huge potential surprise tax bill hiding in plain sight.
It really is one of the most common and costly mistakes sellers make.
Okay, so that's the federal picture. Complex, maybe, especially with recapture. But as you said, manageable if you meet that main 2 out of 5 year exclusion for the bulk of the gain.
Right. For many homeowners, the federal tax ends up being zero or just that recapture amount.
So now, let's pivot. Let's talk Washington State. Because you said their taxes work on a fundamentally different principle.
Completely different. And this is where we absolutely must differentiate between two concepts. Taxes based on your gain, your profit, and taxes based on the total sale value.
Gain versus price. Okay.
In Washington State, the primary tax levy you'll face when selling real estate is called the Real Estate Excise Tax, REET.
REET, R-E-E-T.
Key point number one about REET.
Yeah.
It is based purely 100% on the gross sale price of the property.
The total price tag, not the profit I made.
Correct. It has absolutely nothing to do with your gain or your basis or your improvements or even if you lost money. It's purely on the transaction value.
Wow, that's a huge distinction. So let me test this. If I sell my house for $1 million,
Okay.
but maybe the market dipped and my adjusted basis was $1,050,000, so I actually have a $50,000 loss on the sale, zero gain.
Right.
Do I still have to pay this REIT?
Yes, you absolutely do. Because it's an excise tax on the privilege of transferring real estate in Washington. It's not an income tax on profit.
Got it. It's a transaction tax. How is it collected? Do I get a bill later?
No, it's much more immediate. It's collected right at closing.
Ah.
The closing agent, usually the escrow company, is required to calculate it, withhold it directly from your seller proceeds, and remit it to the state.
So it just comes right out of the check before I even get it.
Exactly. That ensures the state gets paid promptly. You'll see it as a line item deduction on your settlement statement.
Okay. What about the rates? Are they simple?
Not exactly simple, no. The state rate itself is graduated, meaning the percentage increases slightly for higher-priced properties.
Graduated rates. Okay.
But crucially, REET also includes mandatory local add-ons. So the county and potentially the city where the property is located add their own rates on top of the state's rate.
Ah, so the total rate depends on the location within Washington.
Precisely. Location matters a lot for REET. Our sources indicate that when you combine the state rate with these local additions, let's say, mid-priced home in many of the more populated counties might face a total combined REET rate somewhere in the ballpark of, say, 1.6% to maybe 1.78%, sometimes even a bit higher.
Okay, let's translate that. On a $700,000 sale, 1.7%, that's nearly $12,000 just for REET taken out at closing.
That's the right way to think about it, yes. It's a significant closing cost determined solely by the sale price and the property's location. You absolutely have to budget for it.
So REET fit, unavoidable, based on price, collected at closing, rate depends on location.
Got it.
Perfect summary.
Now, this naturally leads to the other big Washington tax question,
Sure.
the one causing all the headlines and, frankly, a lot of confusion for years.
Yeah.
Does Washington state's separate, relatively new capital gains tax apply when you sell your house?
And the answer to that, let me be as clear as possible, is no.
No. Unequivocally no.
Unequivocally, no. Real estate sales are explicitly exempt from Washington state's capital gains tax. Okay, why is this so confusing then? People hear capital gains tax in Washington and naturally think about their house, usually their biggest asset.
The confusion is understandable, mainly because of the history. Washington state did pass a capital gains tax law, ESSB 5796, back in 2021. It survived legal challenges, and it is in effect.
Right.
But from the very beginning, the legislature specifically carved out a massive exemption within that law. The tax only applies to long-term capital gains realized from the sale of certain types of assets.
Certain types, like what?
Primarily intangible assets. Think stocks, bonds, mutual funds, and also interests in privately held businesses, that kind of thing.
Okay, so financial assets, mostly.
Largely, yes. And here's the critical sentence, essentially, from the law itself or the Department of Revenue's guidance on it. The tax explicitly exempts the sale or exchange of real property. Real estate.
It's written right there. Real estate is out.
It's written right there. It's not ambiguous. Your house sale, your land sale, your rental property sale, none of those trigger the Washington state capital gains tax.
That's incredibly important. It's almost ironic. The state passes a capital gains tax, but the biggest capital asset most residents own is completely off the table.
It is ironic, isn't it? But it's the law.
So, why do we need to keep hammering this point? Is something changing?
Well, the reason we need to be crystal clear now is because there have been recent legislative changes to the same capital gains tax law that are getting attention. And people might mistakenly think these changes now pull real estate in.
Ah, I see. Changes to the tax that doesn't apply to real estate might make people think it now applies.
Exactly the source of potential confusion. Specifically, effective January 1st, 2025, there's a new tiered rate structure for the capital gains tax on those assets that are subject to it, like stocks and bonds.
Okay, tell us about these new tiers. Even though they don't hit house sales, it's good to know what the fuss is about.
Right. So for those non-exempt assets, the first $1 million of taxable capital gains in a year, that's after applying the state standard deduction for this tax.
Okay, first million a jame.
That portion remains taxed at the original rate of 7%.
7%. Still significant.
Very. But here's the change. Any taxable gains exceeding that $1 million threshold in a single year,
Yeah.
those gains are now taxed at a much higher rate, 9.9%.
Wow, nearly 10%. How is that calculated?
It's the original 7% base rate plus an additional 2.9% surcharge that kicks in only on the gains above that $1 million mark.
Okay, so it's a marginal rate. 7% on the first million of taxable gain, 9.9% on anything above that. That is a very high state capital gains rate for someone, say, selling a large stock portfolio or maybe a family business interest.
It absolutely is. It puts Washington among the states with higher capital gains taxes for those specific assets.
And this is the point we need to land with absolute certainty for anyone selling a house.
Yes.
We must loop right back to the central, most vital takeaway for our listeners selling property. Despite these headline-grabbing, significant rate increases up to 9.9%.
Correct.
None of this, 0% of this, affects your real estate sale.
That is absolutely correct. Real property remains explicitly statutorily exempt from Washington's capital gains tax. End of story for house sales.
So to recap the state situation for home sale in Washington, you pay REET based on the price at closing, You pay zero Washington state capital gains tax on the profit.
Perfect. That's the bottom line for state taxes on a primary residence sale. Your state tax exposure is generally just that price-based REET.
Okay. So if the Washington gain tax is zero on the house, the federal slice really does dominate the overall tax picture, doesn't it?
Mm.
Especially if your gain exceeds that $250K, $500K exclusion, or if you have that depreciation recapture.
Exactly. Minimizing the federal taxable gain becomes the primary goal.
So what practical strategies can a seller use right now to reduce that federal number? Let's get tactical.
Okay, number one, and often overlooked, is maximizing those basis offsets we talked about earlier.
The capital improvement.
Yes. This is where digging through old receipts and records really pays off. That new furnace 5 years ago, the deck you added, paving the driveway, a major kitchen or bath remodel. All those costs get added to your original purchase price. They increase your basis.
And a higher basis means?
A smaller taxable gain when you subtract it from the sale price. Every dollar you can legitimately add to your basis is a dollar of profit that isn't subject to federal tax.
So it literally pays to find those old invoices for the big stuff.
It really does. A lot of sellers forget about major work done years ago, that $8,000 furnace. Finding that receipt could save you, $1,200 or more in federal tax if you're in the 15% bracket, potentially more with state taxes in other states, or NIT. Remember, routine repairs, fixing a leak, painting generally don't count. But structural, mechanical, significant upgrades almost always do.
Okay, track those improvements. What else reduces the federal gain?
Your selling costs. People focus on the purchase basis, but the costs to actually sell the home are just as important for reducing your gain.
Like the realtor's commission.
Absolutely. Agent commissions are usually the biggest one. But also think about escrow fees, title insurance fees, any legal fees related to the sale, maybe specific staging costs if they were necessary for the sale, certain closing adjustments.
So all those fees listed on the settlement statement at closing.
Many of them, yes. They are subtracted directly from the sale price when calculating your gain. Again, reduces the taxable profit dollar for dollar. Keep that closing statement safe.
Good tip. Basis up, selling costs off. And you mentioned records for depreciation earlier. That sounds critical too. If there was rental use.
Cannot stress that enough. If there was any period of rental use or even significant home office use where you claim depreciation, meticulous tracking of your basis adjustments and the exact amount of depreciation claimed year over year is absolutely essential. The paperwork might feel like a burden.
I bet.
But having those old tax forms like Schedule E is the only way to accurately calculate and hopefully minimize that 25% depreciation recapture tax hit. Don't guess on this one.
Get the numbers right. Okay. Are there situations where this just gets too complicated, where someone really needs professional help?
Definitely. While a straightforward primary home sale might be manageable, some scenarios significantly increase complexity.
Such as?
Things like converting a primary residence to a rental property or converting a rental back to a primary residence before selling. The rules around the exclusion get trickier.
Okay.
Inheriting property or receiving it as a gift involves different basis rules. Selling investment property might involve looking into a 1031 exchange, which is a whole other topic.
Right.
And mixed-use property, say you ran a business out of part of your home and claim deductions, that allocation and recapture gets much more complex.
So if your situation isn't just, I bought it, lived in it for 10 years, now I'm selling it, maybe talk to a tax pro.
That would be very prudent advice, yes. The cost of professional advice often pales in comparison to the potential tax savings or penalties avoided.
Okay, so let's try to boil this all down. For someone selling their house in Washington state, what's the streamlined version? What are the absolute key takeaways?
Right, the quick summary. Best case scenario. Your federal capital gains tax might be completely zero.
How?
If you meet that core 2 out of 5 year ownership and residency rule, that $250K, $500K exclusion wipes out most, if not all, of the profit for many people, unless there's depreciation recapture.
Okay, federal potentially zero. Now, the crucial Washington recap.
Washington State. You will pay the Real Estate Excise Tax, REET, at closing. Remember, that's based on the price and the location. No getting around that one usually.
Price-based REET at closing. Got it. And the game tax.
You absolutely, positively will not pay Washington State's capital gains tax on the profit from your home sale, period.
Why not?
Because the law explicitly exempts real property. Even with those new, higher 9.9% rates kicking in next year for other assets like stocks, your house sale remains untouched by that specific state tax.
Exempt. That's the key word for real estate and the Washington capital gains tax.
Exactly. Exempt.
Okay. So federal exclusion first, then REET on price, state gain tax is 0. Anything else to keep in mind?
Well, here's a final provocative thought for you, maybe something to mull over, building on that depreciation point.
Okay, lay it on me.
Given that we know that depreciation recapture rule, where past depreciation gets taxed up to 25% federally, applies, even when the rest of your gain is excluded under the primary residence rules.
Right. That surprise tax.
What unforeseen federal tax liability might you be slowly accumulating year after year if you happen to use, say, a second home or a vacation home as a short-term rental, maybe through Airbnb or VRBO for just a few months each year?
Because renting it out, even short term, might trigger depreciation requirements.
It often does. And if you're claiming that depreciation, or even if you should be claiming it but aren't, you're potentially building up a future recapture tax bomb without even realizing it, payable when you eventually sell that second property.
Even if you use it personally most of the time. Wow. That adds another layer, especially with the rise of short-term rentals.
It certainly complicates the simple sale down the road, something to consider carefully.
That's a great point. The key takeaway today really feels like knowing these distinctions. The federal exclusion rules, the price-based REET in Washington, and critically, that state gain tax exemption for real estate. Understanding those three things means you can walk into that closing process much more confidently.
Absolutely. You know where the real potential tax burdens lie and where they don't.
Now you know what questions to ask and what records to keep. Hopefully this deep dive helps you navigate that sale much more smoothly.